Hi everyone, and obviously hello to Jonathan, who's going to be who's the star of today. Really, I am a mere facilitator, and I'm going to introduce Jonathan very shortly. So, this webinar will be about 40 minutes or so. I believe Jonathan's going to speak and present on the subject of funding and getting funding in 2023 and what the options are, probably for about 10-15 minutes, I think, if that's right, Jonathan. And then if any of you would like to ask questions, could you put them in the chat box? I think Zoom asks you to email them, but ignore that. Put them in the chat box. I'll filter as many as I can get through for about 15-20 minutes after Jonathan has spoken, and then we will we'll close off. So welcome everyone, huge welcome. This promises to be very informative. It's very relaxed, hopefully very enjoyable too, and Jonathan, as you know, is a founding partner of Mountside Ventures, very involved in the ecosystem of fundraising for startups and growth businesses. And I will now let Jonathan take it from here. So thanks very much. Hi, Jonathan.
Thanks, Mark, and hi everyone. Nice to see some cameras on and friendly faces, but of course, if you've got a call and you need to jump off, feel free to jump off video. So, I normally run these a couple of times a week, and we can go into a full 8-week program once a day, or we can go for a kind of condensed 20 minutes, and there's all the training and workshops in between. And so what we're going to try and do is rattle through as much content as possible in 10 to 15, give you a bit of an overview into the fundraising landscape. I thought I'd probably split it into a quick note on who we are, a little bit on what's changed in the fundraising market, and kind of tips if you're thinking about your company's raising, a bit on funding options. So what are the kind of 12 to 16 options of the market, a bit on term sheets and a bit on valuations, and all kind of, real kind of, so the term sheet stuff is kind of based on our 2022 data, where we asked 200 VCs for their typical terms, and valuation is what we're seeing at the moment in the last couple of months. And then funding options, a kind of selection of funding that some of our clients have received. So quickly, in terms of who we are, so all I do is spend my time on fundraising options for companies. So we work with both founders, management teams, but also VCs and other funds. So you can imagine at the very top of the food chain, you've got your family offices, your corporates, your government. They typically invest in funds. That might be VC, PE, venture debt, credit, whatever that middle tranche is. And then they, of course, invest in early stage companies, founders, startups. And so what we do is we help both the founders raise from the middlemen, the VCs, and we also help the VCs raise from what we call LPs, who are the investors in their funds. And so that puts us in a nice position, understanding the entire landscape and the flow of money, both from the kind of family offices down to the funds, and then down to the early stage companies. We typically work on a kind of workshop-based model or one-on-one with companies. So it could be anything from supporting on the financial model, to the deck, to going out to market, to closing the round. So that's a little bit about us. I'm going to start on a few tips for the current market. I've got a few slides, but I might share those in 5 to 10 minutes once we've got through some of these high-level points. So what are we seeing in the market at the moment if you're thinking about funding? Number one is it's taking a lot longer. And so typically funding rounds on the equity side might take 6 to 9 months. On the debt side, you're normally looking at 3 to 4 months. Those have extended by perhaps 2 to 3 months. The diligence time that we're seeing from equity investors has gone up probably 2x. The last 3 to 4 deals we've done, investors are using time as the best way of diligencing companies, which I don't blame them. If you go and say we're going to hit this milestone in 3 months, they'll just say, well, we'll see if you hit it in 3 months, and then our funding will be subject to that milestone. So that's becoming very common. And so the advice we give to companies there is to make sure your data room, your modeling, everything is in order as soon as you receive that term sheet, to minimize the amount of time that you can control between, you know, signing heads of terms and cash in the bank. That's number one. Number two, we're seeing a lot of investors talk about cost cutting. Many say that you need to increase revenue whilst cutting costs. And when challenged, don't really have any way of describing how to do that in any practical terms, which is pretty much impossible. So you often need to choose one or the other. And there's, of course, a focus on cutting costs, looking at strengthening relationships with existing customers, reducing churn, and generally trying to keep headcount down. We're seeing that also across VCs. So many investors are also cutting costs. So some big names like Optimise, who are one of the big Series A fintech investor, they've just halved their team as a result of the market. And so investors are doing it as well. And the main aspect is to try and streamline as much as you can. The third area we're seeing in the market is, if the last 10 years was all down to growth, at the moment it's all about profitability. And I think you've seen that similarly in the public markets over the last couple of years. You had all the big listings, the WeWorks of the world, all about growth without really looking at the underlying numbers. And of course, if there's many, you know, FDs in the room, that's probably music to your ears, focusing on profitability rather than growth at all costs. And that is fundamental change in the market. And so both the equity investors are probably following the debt investors a lot more, because, you know, debt investors is all about profitability and paying back the interest, whereas equity investors, it's let's go for that moonshot in 5 years and return the entire fund. And so there's been a convergence between the two types of funding from that regard. And then my last tip is to hold off going to market if you can. If you're in a position where you don't need to raise money, be it through all the different methods, our advice generally is to hold off. We've got a few clients in the market at the moment that are profitable, but there's also quite a few that are struggling purely because they haven't either got the growth metric, which generally for an equity investor, you're looking at around 50% year on year. For a debt investor, you're looking at 25% year on year. And if they don't have the growth metrics, they need to push profitability. And of course, if you're profitable, you can afford to wait. And so the ones kind of stuck in between are those who don't quite fit either criteria. Feel free to jump in with any questions or pop them in the chat. I'm going to share my screen now and just give you a whistle-stop tour of the funding options. So here they are. We actually, I might make this a bit smaller. We actually update this very often. Can you give me a thumbs up? Can you see this without the video, or can you see videos on your screen? Give me a thumbs up if you can see all of it. Okay, cool. So here are the options, the 12 options that we typically look at when working with companies. You know, some of these are quite obvious. I'm sure you've come across angel investors, family offices, etc. If you're a UK-based company, of course, EIS and VCT funds are super relevant. I've just done a post about this on LinkedIn. So if you jump on my profile, I've just listed all the most active EIS, VCT, and SEIS funds in the UK in 2023. So feel free to jump on that list if that's relevant for you. If I was kind of to summarize the options available at the moment, if you're revenue generating and you have more than £20,000 going through the business of recurring revenue per month, then revenue-based finance, top right, comes into play. Revenue-based finance has shot up in the last year, going from practically nothing to a few hundred million across kind of only like 2 or 3 providers. We've done a lot of work with companies raising revenue-based finance. It's quite a quick process. So I mentioned, you know, the 3, 6, 9 months. This one is more of a 1 month type or even shorter. The work we've done with companies here is we do a quick review of the model, make a few tweaks for this community, go out, and typically within a few weeks you get a yes or no answer. The way it works is We've got relationships about 20 of the RVS. There's about 20 or so in Europe, a couple more in the US. And the way it works is you go in, you plug in your Xero system, and they say, okay, this is how much revenue you've got. We're able to lend you this amount. And so it might be road cost. Got it. I'll include that. So it might be it might be kind of 1 times, 2 times, or up to 6 times your monthly revenue. So if you've got 100k of monthly revenue, you've got 1 million monthly revenue, just multiply those numbers between 2 and 6, and that's the range. And we can generate that type of funding quite quickly, as long as the revenue is recurring. So that's an interesting one for many of you. Venture debt only comes into play under 2 conditions. Have you raised a big equity round previously, or are you profitable? If you don't tick either, so it's not and, it's or. If you don't tick either, then there's no point kind of looking at pursuing this. If you do tick both, typically venture debt providers lend 1/3 to 2/3 of equity. So if you've raised 10, you could borrow approximately 3 million and 6 to 7 mil of equity. Loans and asset-based lending, that's generally for IP rich and that have got real things on their balance sheets. And then you can lend off that. And a grants and other support, of course, is its own category altogether. That's free support, but of course, the catch is that the time it takes you to actually apply. I was at an Innovate UK presentation last week, and they had around 86 million to give as free money to UK businesses. I don't know if all of you are UK, but there's also, if you're non-UK European, there's also Horizon, which is a very generous scheme in Europe. And they have the UK equivalent have got 80 million quid, and they try to give between 1/2 and 2 per business. And so there's lots of proposals here, especially if you're in the clean tech, green tech, healthcare, biotech, anything to energy, transport industry. They like those hot topics at the moment. VC funds, your traditional sexy, 50 to 100x type return, always around, and that's one of the areas that we specialize in. Similarly, corporate venture capital funds. Surprisingly for me, they've been active. So in the last 2 years, 25% of all deals have included a CVC. Which is pretty insane if you think about the market going down and the corporates being a lot slower. I was surprised that around 1 in 4 to 1 in 5 CVCs have been active in a deal. Equity for services has come up recently. Think of Channel 4 Ventures. You're trying to generate some cash and generate some business. You want to approach Channel 4, and instead of going direct and putting 2 million quid into their advertising, Channel 4 invest in you, take 20%, let's say, and give you 2-point-something million of credits. And so that's equity for services. They provide a service and they take equity. It comes out cheaper if you've got a specific target in mind. Crowdfunding, of course, I'm sure everyone's familiar with. Issue pros and cons. Recently, the con is you've got there's a lot of marketing costs. There's a lot of issues with getting your profile at the top of the list, and you've got to have loads of cash ready. So i.e. when you go out within the first hour, you've got to fill 50% of the round to shoot up the metrics. So it's only relevant for a small group of businesses. And then VCTIs funds I mentioned, you can jump on my LinkedIn and see the latest list, but these are the most relevant equity investors in the UK for companies who are not looking to 100x, they're looking for 10x. So for example, you're building a business alongside your team, and the management team is, let's say your business is valued at 10 million and you're quite happy with a 50 million exit. Let's be honest, most of us would be. This is a relevant type of investor for you on the equity side because of the tax breaks. Instead of the 50 to 100x return that the VCs are asking for, they're asking for much lower return profiles because the investors in the funds are already getting a tax break. They're getting 30, 40, 50% sometimes of money back when they invest, and therefore the gradient is smaller. Family offices, much like angel investors, are relevant for everyone, but they're hard to find. And so when we work with companies and we operate as their advisors for the raise, we never rely on family offices. They're kind of like a bonus. And in the institutional funding process of making sure you've got a deck, a really good 5-year financial model, a really good data room, a really good investor FAQ doesn't necessarily apply to family offices, because often the decisions are quicker and they don't have they're effectively investing money on their own behalf. The main difference between institutional funding and angel and family office funding is where the money comes from. On the one hand, family offices and angels invest their own cash, and 99% of the market invest someone else's. And if you invest in someone else's cash, of course, you have all of these processes behind you to work through. So the question was on costs. So angel investors and family offices typically don't charge anything since they're in cash, but they are in the minority. Everyone charges something because they need to be paid. So angel groups typically charge 10%. VCTs typically charge a couple of percent arrangement, and then 1 or 2% a year for 3 years paid in advance. So approximately around 10%. VC funds, the big brand of VC funds, they don't need to charge 2, 10, 20%. They typically recharge the legal fees and the DD fees to you when you raise money. CVCs generally don't charge many fees because they're a corporate and they can take their fees off the parent. Equity for services normally charge VAT. So that's something that you have to be careful about because, of course, you're paying effectively for the ability to take their money, because VAT is on the equity, is on the service. Crowdfunding, normally you have to pay 10K flat fee and then maybe a 7% success fee. Revenue-based finance, their fee is effectively the interest, quite interestingly. So you might be paying 10-12%, and that's effectively the discount. So one of the things that we have with many of those and many of the debt funds is we have preferential rates when we send companies to them. But broadly, you're paying around 10-12% discount, which is a different mentality than the debt, because with a venture debt, you're paying normally 3-4% of arrangement fee, and then you might be paying 10-15% interest a year. And so the way to think about debt is, can you as a business grow quicker than the cost of capital? So if the cost of capital is 15 to 20, you need to commit yourself to growing quicker than the 15 to 20%. If the answer is yes, then it's probably worthwhile taking debt. Loans and asset-based lending, that's normally a couple of percentage off the asset, and then grants, normally there's no fee apart from the time, of course. Cool. So that's any questions, just let me know. So that's source of funding. We've done in record time. Let's do a quick note on term sheets. So we did one of the largest term sheet survey and report last year. We have over 200 investors tell us that for terms, and then we summarize them and publish them. If you go on, go on Google and type in Mountside term sheets, you'll be able to access it for yourself. We had lots of respondents, and between them, they had £11 billion. So a pretty mighty investors. I'm not going to go into too much detail what a term sheet is. We spend a lot of time with companies on this, and each term sheet is very different. But broadly, they go into these kind of 4 categories: valuation, which is terms, deal conditions, control, and binding terms. And these are the kind of typical things that we've seen. So in the market at the moment, it's still 1 times non-participating, which means the investor gets the money back first when they invest. Exclusivity, you can't talk to anyone for about a month. Legal fees, I mentioned, for VCs are recharged. So on average, this is 1 to 2%, as opposed to the EIS and VC funds that take around 10%. Board seats typically required A and preferred for other rounds. Founder vesting, always an interesting one for the management team. You're telling me that I've just spent 5 years building my business and now I need to give away all my shares? Yes, that's what 99% of investors ask for. And then you claw them back over a 4-year period. No ratchets. Tranche funding depends on the type of investor, and then for share options, you're looking at 5 to 10% typically on an option pool. So this is kind of your typical term sheet. And then to finish, a few things we're seeing on valuations. They've fallen for late stage companies, not much impact for seed and A, quite a lot of impact for B and C companies. Less pronounced in the data because of the re-ups. And so you'll see, oh, but why isn't all this stuff showing in PitchBook and all the reports? Well, it's because most investors are doing CLNs and doing internal rounds, which aren't necessarily published. Good companies continue to raise funding. I know we as advisors being a bit more picky on the companies that we work with. We normally review about 100 per month and work with 1 or 2. And then with the others, normally we provide resources and do workshops much like this one. But I know that we're being a bit more picky because the criteria has gone up a bit. So generally, we start working with companies who are generating about 1 million to 20 million of revenue per year. That's kind of the sweet spot. And then the last one is there's a continued upward trend over the last decade. So you should see, if you look at the seed and A and B, there's a kind of an upward trend in valuation, and you can factor in inflation and round sizes getting bigger and all sorts of different things in that analysis. Cool, that was it. As you can tell, we can probably spend an hour talking about every single one of those points, but I try to rattle through them to give you an overview of a bit about us, types of funds available, a bit about valuation, and a bit about what is standard when it comes to equity term sheets.
That was great, Jonathan. In fact, I've got a couple of questions myself, actually, but and by the way, everyone, if I didn't say at the beginning, my name is Mark Masson. I'm a director and partner with FD Recruit, an exec recruit group, and do connect with me on LinkedIn if you'd like to. But has anyone got any particular questions? Do you want to just raise your hand and put it to Jonathan? But Jonathan, in the meantime, perhaps before a few questions come through, did you say that the sort of size of companies, your sweet spot is 1 to 20 million revenue?
Yeah,
pick that up. That okay.
Exactly.
And
so that translates to about raising 2 to 30 million, either equity, debt, whatever type of funding. We don't do much in grants, but anything that's not grants, we cover.
I'm with you. And you mentioned some sectors, but are you fairly sector agnostic, or do you have a preference? Or
yeah, absolutely. We've got relationships with about 2,500 investors in Europe and lenders, which is pretty much the market. And there's a few family offices that it's very hard to quantify who's who, and there's probably an endless list. But on the institutional side, we know most of the European investors. Don't do much in the US because we're not regulated to do anything there. And as a result, we can be quite sector agnostic by understanding what the population is after.
And I hope you don't mind. I know I'm sort of firing questions at you, but I know you like that. What I mean, UK percentage-wise of your clients, well, what would you say, or is it possible to comment on that?
Three quarters UK, and then 25% Germany and the Nordics.
And bound to offend somebody here, regionally in the UK, are there more buoyant pockets or less buoyant, or is it not really?
We work across the UK. So we've got some companies in London, some in Bristol and Bath, Manchester, Birmingham, all sorts really. There's actually a bit of often there's regional pots of capital outside London that you can tap into. So FSE, for example, do a lot in the south, and Mid-Ven and Mercia and Victoria do a lot in the north. And then in Scotland, you've got Pi Equity and a few other funds who specialise there. So there's very different pockets of capital to tap into. And every time we work with a founder or a company, we figure out if there's anything specific to them. Maybe the diversity of the founders, maybe the location of the team, maybe the nationality. So some investors only work with certain nationality, for example, Israeli founders or French founders, etc.
I mean, how do you see the next? I mean, is it finger in the wind type stuff? But how do you see the next couple of years for startups and the sort of 1 to 20 million type SME?
Yeah, it's hard to tell. So we've done about 30 million of raises in the last 6 months. But a lot of those were kind of, diligence from a couple of months before that. So the 6 months is a bit of an anomaly. And I suspect that we'll continue raising that much, but probably it'll be a bit harder. And so we'll have to go to a wider pool of investors. And so, the value prop is, if we spend all our time figuring out who the right investors are, a big part of one of the services value prop for the teams we work with is they have to do that, right? And it's difficult figuring out who's raising and who's not. And by working with VCs on their own fundraise, we can understand when they're raising and when they're not. And so the biggest pain we've seen is funds themselves struggling to raise. Because if you imagine the bottom of the food chain, which, let's assume that everyone's a company, the pool of capital narrows the higher you go, because the higher you go, the fewer people above you. And so if you're a startup, you've got so many options, because you've got all the 16 options I talked about. But if you're a fund, those options are limited to maybe corporates, government, and family offices. And then if you're raising a fund of funds, your options are then further limited to only family offices. And so the higher up you go, the more your options are limited. And if the equity investors and credit lenders are not raising their funds, then of course that has a knock-on effect down the food chain. And so that's what we're seeing at the moment.
Oh, interesting. And Jonathan, you mentioned revenue-based finance, and that being a sort of relatively new thing. Are all the big banks involved in that, or are there very sort of specialist boutique type lenders? Or
I think out of the 20 I mentioned that we see in the market, the majority are new. The lenders the big banks aren't doing much. They're typically doing debt. So, an HSBC last month announced £1 billion for startups. But then when you dive a bit deeper, the startup has got to have raised already 20 million of equity, and they're looking to lend 50 million minimum. So then it's not really a startup per se. But I'll drop my email in the chat if anyone wants to drop me a note. I'm happy to have a chat with anyone on the call about any of the things I've talked about. With a question from
Stephen's actually Stephen has asked a sort of follow-on question there. Can you see that, John?
Yeah, which the question is, the costs are expensive compared to high street. The majority of the high street are only lending for super profitable or asset heavy businesses. Anything that's not very asset heavy or profitable is going to struggle on the high street. And so the options are those 16 points I mentioned, which the high street only sits in asset-based lending. The high street doesn't sit in any of the other categories. And that's because 9 out of 10 startups fail. So if I'm giving money to a startup, 90% of the time I'm going to lose the money. And so, the only way of it working is either you factor it the revenue, to reduce risk. You factor the asset, which is a traditional way from the last 50 years. You factor in that it's got equity investors, so the equity investors might bail you out. You might factor in the fact that at least one of those will exit 100 times, like an Uber or a Facebook, and therefore will pay the way for all the other failures. And so startups, on the face of it, I think when it comes to funding, have it easier than you expect. Because if you're asking money from an institution that knows that 90% of you will fail, and they're still lending and investing. So I'd switch that question back, saying, why on earth are these other options actually lending so much money to companies, as opposed to they're expensive? Because the cost is simply to pay part of the wages. If I'm if I've got £5 million to invest, and I invest over 3 years, and I don't charge any of you fees, I can't pay my wage for 3 years. I have to wait 10 years for an exit. And of course, that's not sustainable. And so the fees are effectively there to pay the wages of the team doing the diligence and doing the sourcing, as opposed to maybe a high street bank who've got billions in assets and their core business isn't working with startups. It's charging billionaires to manage their assets.
Thanks for that. And another comment from Stephen.
Say startups, I'm talking generic SMEs. I just use that interchangeably. So anyone who isn't a corporate, and you could probably, again, how you view corporates, right? Google have been around for 20 odd years. Are they a corporate? Are they a startup? With one of the biggest listed companies in the world. Some people still call them startups. So sure, you can use that word interchangeably. When I say startups, I mean SMEs. There's a few banks looking at non-traditional IT business for debt. How do they compare? So they compare in the sense that revenue based, you don't need any assets. So non-traditional IT businesses or businesses might have something of value, whereas the majority of tech companies have nothing of value. The thing that's valuable drives the revenue, but itself, it's not valuable. So think of data or AI or what have you. The value is in the revenue it derives. And so the revenue-based finance are able to lend based on that future revenue, whereas traditional businesses, like maybe a funding circle or funding options loan, or going to, you know, NatWest and getting 50 to 100k, whatever, wouldn't be available to you. But
okay.
That's let me be clear that my use of startup is, I guess, moot. If you think of the top 5 companies in the world right now, being launched less than 20 years ago. And
Okay, that's sorry, Jonathan, were you going to say something there?
No.
We have a
Stephen's on a roll. I think everyone's benefiting from his questions today.
Yeah, that's great. Thanks very much.
When I say wait, it's impossible to tell. I have no idea. I thought Jan might be better. Some gloomy people are predicting 2-3 years. Some more optimistic people are predicting 6 months. And the answer will be, when does the public market spring back up? And I think if you knew that, probably make a number of bets, be very rich. Personally, I'm still looking to invest in inferior goods, those that do well in recession. I wouldn't necessarily be investing in luxury items right now. Tim, you're on mute, Mark. Tim mentioned.
Yeah.
Project-based business, house building, sector-facing challenges, economic. So, sorry, are you asking which sector? Tim, do you want to jump on audio? I didn't quite understand the question.
Yeah, I suppose if you like, in a sector that doesn't make regular profits but makes lumpy, bumpy profits. Just wondered how it was viewed when one of its main competitors, HAs at the moment, is actually government grant funded, and just how that sort of, if you like, lumpy, bumpy sort of business is viewed at the moment.
I think viewed in the sense that, you know, everyone's going through lumps and bumps, so I don't think viewed any, you know, necessarily too negative.
Actually, Wayne has asked a question on
Compared to everyone else.
Timelines.
Exit timelines for each option. Exit timelines depend on the risk profile. Tim, if you've got any more questions, just ping me a note on my email. So exit timelines. So the EIS and VC funds are looking at 3 years. VCs are looking at 5 years. Venture debt, typically 3. Revenue-based finance, 1 year. You're taking the loan over a 1-year period. Typically, family offices, unlimited. That's the whole benefit of them. Patient capital. Things are moving towards that, of course, as you can see from the data showing exits. You know, it takes 12 years to IPO, instead of 8, what have you. Companies are staying private for longer, all that kind of mantra. Grant not applicable, and CVCs don't really think about it too much in the short term unless they're financially orientated, because most corporate venture capital funds, you know, might look to invest in you because of the technology that you have. So if you use the kind of 3 to 5 as a good rule of thumb, you want to aim to be profitability within 3 years if you're taking funding as a maximum.
Okay, no, thanks for that. So I don't know if we've got maybe 1 or 2 more questions before I bring it to a close, but obviously, you know, as Jonathan says, do get in touch with him directly. You've got his email. If you haven't got the email, get in touch with me. I'll put you in touch with Jonathan. So I think David's asked a question, Jonathan.
Yeah, and so Connor first, cool. Small biotech, I think very hot at the moment. Good luck with the term sheets. If you want any intel on it, ping me a note. You know, I don't know. As the answer to that depends on your growth. I'd say we're working with a couple of companies that have come back to us and looking for the next round, where we did their A round, looking for the B round, and one of them's going flat, the other one's going down, the other one's going up. Depends on the data, how you can portray it. But in the market, it wouldn't be uncommon to go down round. Where do you suggest any startups look for funds? Well, you can come to us, and that's our day job. Or if you want to do, we've got a list on our website that's free, so you can jump on there and have a look. In terms of working for us, we're success based only, so we provide all the support for 6 months typically, and don't take anything from you until the round's closed. So, and that's our way of trying to minimise selection bias by working with good companies, as opposed to those who could need a whole raft of support. But yeah, our website has got a complete list of all investors on the equity side. We don't publish the venture debt ones or the RBF; they're constantly changing. And so lists would be out of date within 3 months, but the VCs are more kind of a few years. So we publish that. And then if you go on my LinkedIn, you've got the last 2 weeks. I've published 3 different lists of the 3 types of investors who are tax efficient. So you can jump on that, David. I'll look out for your connection request.
I've already sent it.
Nice. I live on LinkedIn. Any other questions?
No, I think that's all good. Well, look, I'll bring this to a close. Jonathan, thanks very much. That was great, and of course I'll drop you an email, and I'll be doing a post on LinkedIn. I'll tag you in on that. And also, very much like to thank everyone for attending. I hope you all got something out of it. I'm sure you did. And as said several times, feel free to make contact with Jonathan about your business or fundraising or anything. Also, feel free to comment on the post I put on LinkedIn. Feedback's always great to hear. Hopefully we'll interact on something again in the not too distant future. But have a great day, everyone.